Coming up today, stocks on a 4-day winning streak. What happens when we hit all-time highs? The sell signals that are building, meme stocks ripping, will Buffett buy the dip in oil, gold rips up to new all-time highs, and why the financial media is not reporting on it. It's a good one, guys. Let's go. And welcome back, everybody. Thanks for tuning in with Click Capital today. Got another bit of a continuation in the market today after yesterday's big reversal day. Stick with me and I'll show you some stats on that shortly. S&P 500 now within a stone's throw of all-time highs. In fact, less than 75 points away from the 56.70 high back on the 16th of July. Market color turning very bullish across the board. Still got weakness in the energy sector, trying to find a short-term bottom. Financials still haven't bounced, and volatility dipping a little up the front. Everything else pretty much getting a bit of a bump up. Led by mega cap tech once again, up 1.5% as a group. Also good to see small caps up 1.29%. Still haven't reclaimed their 50-day yet, as mid caps haven't either, but was quite some bullish breadth across the board. Pretty much every single stock sector finishing higher on the day, with energy trying to find a bottom here. Short-term oversold, the weakest sector out there. But what stole the show today was gold and gold miners. Junior gold miners sector up 6.6%, along with a nice rip up in silver, up 4% on the back of gold. Now currently sitting at a new all-time high, $25.87 US dollars per ounce. And stick with me today because it's really interesting. Financial media at large are not really reporting on this, which I found interesting. And so I'll offer up some theories about that, and I'll show you all the financial media news sites and their current home pages. Lack of reporting on gold. There's a look at Apple after unveiling their new iPhone 16 to start this week off. Pretty muted response from the market here, trading pretty flat. We are getting a bounce in some of the others that have been weak of late. Microsoft also reclaiming its 50-day. Amazon pushing up, and Alphabet Google having a good day after we fired off some reversal signals earlier in the week. Bouncing off these lows. Meta holding up pretty good, not too far off highs. And there's a look at Tesla holding on to recent gains this week. But I'd say what's really helped this market, and the Nasdaq especially, as we're seeing a bounce back in growth, cyclical stuff, the semis, is Nvidia. After a really good day yesterday, upgrade from analyst Jensen Huang coming out, sprinkling his magic on the market again. And once again, Nvidia slapped on almost another 2% today, sitting above its 50-day, looking to have bounced off that $100 level beautifully. They have still a bit of work to do before it breaks out to new all-time highs above $140 a share. Could still very well consolidate here for a while. That move in Nvidia has kind of led the risk-on rotation this week, kind of a hard and fast snapback after we got the weakest week last week in over a year. Yesterday was a huge reversal day. Early on in the morning we were down over 1.5% and we ended up closing up 1% on the day. 2.5% reversal in a matter of hours. Looking back in history, when that's occurred before, it's pretty bullish. 1, 3, 6 and 12 months out. 77% both for 1 and 3 month, and 72% for both 6 and 12 month. The market is higher after we get that key reversal day. And so it just continues to be such a polarizing subject. Has Nvidia already topped? Is there AI boom already over? This is like Cisco in March 2000, or is it like 1995 and we're still just in the third inning? Well, according to Bank of America, they say we're only in 1996 and the AI boom is still in the earliest days, and that AI's impact will be felt sooner than past tech booms. Skepticism about AI has mounted recently as investors get impatient to see AI return. And so there has been a bit of a building of narrative of late. Where's the ROI on all this AI spend? And that's what we've been looking for recently, is for that narrative to really take hold, along with Nvidia and semis taking out some key support levels on the chart, as to at least give a clue on the sector and its potential impact on this bull market. But again, it all comes down to the eye of the beholder. It's not hard to hear the term AI bubble. Just about every other YouTuber out there is calling it that. And it very well could be, however, without a doubt, AI is going to affect just about every part of the economy and our lives going forward. Just looking at the explosion in compute processing power, it's jumped 3,440% from 2015 to 2023. And that just opens up so much more applications and use cases for what companies can now do with their data. And Larry Ellison's right. This is huge. The explosion in compute power, the processing of data, that all has to be housed somewhere. And you could pretty much say the AI boom kicked off in early 2023, just last year, after the launch of ChatGPT and Microsoft's investment in it. Just maybe this AI boom lasts longer than 2 years. Maybe it does have more impact on society than the internet, than the PC, than the mobile phone. And so maybe the AI bull market goes on longer for those technologies. Maybe it gives the secular bull market and railroads that lasted for almost 70 years in the 1800s a run for its money. Nobody knows for sure. However, I don't see the AI boom going away anytime soon. One of my best performing stocks of late is Palantir, and I've got a number of other key AI stocks on my watch list that I'm ready to enter once the right setup emerges. But like I said, it's not just AI stocks that are benefiting from the AI boom, it's everything. According to Bank of America Global Research, AI may drive margin expansion for 23 or 25 industry group. Their forecasts over the next 5 years, of course, software and semis will be the biggest beneficiaries of the efficiency and productivity gains driven from AI, but also energy and utilities will help maximize efficiencies and output. Media, REITs, transports, capital goods, real estate, materials, banks. AI is already driving material gains in profit margins. And just looking at other long-term secular trends, for example, the switch from physical currency to digital currency, the push to electrify the world, digitization of everything, but there could also be another secular trend that's just emerging, the switch from human workers to robots, and that could very well drive margins for years ahead. But either way, something's keeping the stock market afloat, because we've pretty much got bond yields and oil diving off a cliff, saying there's very good chances of a recession around the corner, the economy's weakening, have the stock market sitting 70 points off all-time highs, with analysts predicting strong corporate earnings growth well into next year and out to 2026, with a broadening of that earnings growth out from the mega cap 7 across the rest of the market, mid caps and small caps as well. And so the stock market's still excited that this soft landing scenario can continue, along with the tailwind of lower rates just around the corner, which if it does materialize is good for small cap investors like myself, because we've got a great starting valuation here. Just looking at the relative forward PE of the Russell 2000 versus the Russell 1000, small caps versus large caps, down near multi-decade lows that we last saw in the late 90s, in which the S&P 500 and the Nasdaq especially topped out, fell 80% over the next couple of years. Small caps went on to outperform for a decade. And in fact, just looking at a long-term chart of the compounded annual growth rate of small caps versus large caps, this has been the longest period of outperformance of smalls versus large. It's been going on for over a decade now. And you can see the market kind of switches from one regime to the other, where small caps underperform, then they outperform, underperform for a few years, outperform for a few years, potentially even longer, and then underperform. And so the stock market could very well hit new all-time highs. Who knows, potentially tomorrow, if not next week. We're certainly pushing up again, looking like it may have another stab at it. And just looking back at history, when the market does make a new all-time high, generally a bullish signal, as you could kind of think of it as having no overhead resistance. It's not a previous point where people may have bought and they've waited for the market to come back to that point to get out, or a level where sellers have proven to come in before. It's pretty much blue sky territory. There's nothing really more bullish than an asset hitting new all-time high. And that shows up in the stats as well. After the S&P makes a new all-time high, only 9% of the time we're down greater than 10% a year later. And 3 years out, that only happens 2% of the time. And looking 5 years out, that's never happened. But once again, it's an interesting setup. No two times in the market are exactly alike. There'll always be similarities. However, there'll also be differences. We certainly have a lot of key sell signal, the biggest being the uninverted bond yield curve, record valuations on some measures for a lot of the stock market, especially looking at the stock market versus GDP. For the here and now, we've still got elevated volatility, seasonally weak period, and a lot of people that are still piling in to call options, which is typically what you see near a market peak. And once again, it's remarkable how closely the price action we're getting this year is resembling that of last year. 2024 here in the green line, 2023 in the blue line. Just like last year, the market peaked out in July, rolled over into late October before it ripped up into year end. And so is the market going to keep following this pattern? We've got a few more months of correction, or at least consolidation, or are we about to break away from last year's pattern and hit all-time highs soon? But just looking at cyclical bull market and their average length and where we currently sit, if you measure the start of this bull market from September 2022, S&P bottom around 3,500. We're about 24 months in. Looking back in history, the average cyclical bull market median duration is a little over 31 months. So if this bull market was to peak out at that median duration, that would mean another 7 months to the upside, which would take us through to about April next year, or close to May. Maybe that sell in May and go away expression could play out. I certainly see a scenario where a lot of federal government agencies and the Federal Reserve aren't as really incentivized to prop up markets after the election. Certainly wouldn't be surprising. Could also be the scenario that things get too good again and inflation comes back. Then before we know it, we're talking about the Fed hiking rates again next year. Or on the other hand, we may not even be halfway through the 60-month AI-inspired bull market that we've seen before in the past as well. But one thing I've noticed different about this bull market compared to prior bull markets is that it's just so easy to participate. These commission-free stockbroking apps that have been around for a few years now, and widespread participation. And it's something that's structurally changed over the last couple of years is the so-called meme stocks, where you have personalities and influencers on social media just being able to post a meme or get together on a forum, can post about a stock, and next thing it's ripping up like crazy. And of course that affects the valuation and can help the company survive longer, like we saw with GameStop. Keith Gill posting memes, causing a pile-on in the shares, and the company comes out does a secondary offering and can replenish their balance sheet, at least kick the can down the road for a while longer. Now we've just seen over on Reddit, a lot of the meme traders posting about Wolf, Petco. And this was after the meme last week from Roaring Kitty, screenshot from the movie Toy Story. He's dropping the toy with a dog face over it, and which was previously known that he owned Chewy shares. And that initially caused a little bit of selling in Chewy. However, it's had a pretty good bounce back this week. But now the meme crowd has moved over to Petco, similar company to Chewy. On speculation, Keith Gill may have taken a stake in Petco after dumping Chewy. That hasn't been confirmed, but this is another small pet food supplier. Market cap only 1.2 billion. But look at that move up yesterday after earning 32%, slapping on another 11% today, breaking out to multi-month high. And clearly some big signs of accumulation here. Just looking at my volume candles. However, just getting back to GameStop, which we haven't looked at for a while. After that earlier mania back in May this year, hasn't really done much since then. In fact, it's just trading around the company's first secondary offering they did after the initial spike. The average volume weighted price they achieved for that, just above $20 a share. They just reported earnings a couple of days ago, reported 1 cent per share in earnings, but not doing as well. AMC, which just zooming out, got absolutely clobbered this time last year and hasn't been able to recover. And there's a look at Reddit, pretty much gone sideways since it's IPO'd. And so it's interesting, the meme space, there's still some activity. Some are completely dead, but others are still showing signs of life, like Eastman Kodak. And in fact, where a lot of the meme traders trade, over on Robinhood, they're actually having a pretty good year and actually just came in with a pretty good earnings, beating expectations. So this is another part of the market you can use to gauge kind of like investor, or at least small investor enthusiasm. And so I've been seeing a little bit of action in some of these names of late. Just moving on to oil. Got a little bump up today as Hurricane Francine disrupts output in the Gulf of Mexico. International Energy Agency cuts its forecast for crude demand growth as well. The overall impact of Francine is still developing as affected areas pivot to assess damage to infrastructure. And like I've been saying, I've been waiting to hear if Buffett's going to buy this dip in oil like he had been last year. He has slapped $13 billion on Occidental Petroleum. That stake now looks to be underwater, and he is flush with cash, having just sold half of his stake in Apple recently. He's been selling Bank of America. His cash pile's at all-time highs, almost $300 billion. He's got enough cash to take the whole company over if he wanted to. I still think it's possible he has one more really big acquisition before he retires. And there's a look at Oxy today. Put in my third consecutive reversal signal. If Buffett still likes the stock and wanted to up his stake, I'd say he'll be doing his buying around these levels, low $50 a share. We see those big fat green candles come in. That could very well be Berkshire in the market. And we are getting some potential signs of a short-term reversal at least. The largest oil stock, ExxonMobil, trading up today, and Chevron looking a little stretched there, along with Shell as well, really deeply oversold in the short term. And there's a look at Berkshire, which had been trading really well up until a week and a half ago. Got a little short-term overbought, it's pulled back to sit in its 50-day, along with the rest of the financial sector, with Wells Fargo being the weakest. We also got some more inflation data today. Producer Price Index rising 0.2% in August as expected. Core came in a little hot, up 0.3%. Not a huge reaction in government bonds. Did have a soft bond auction today. And just looking at Fed fund futures, just increased their chances from yesterday that we could get a 50 basis point cut next Wednesday, sitting at 28.72. I put my odds about 80-20. At this stage, I think there's more chance than not they'll go 25 next Wednesday. And bond yields are still very weak here. The 2-year at 364. But once again, high yield bonds are holding up good, sitting at yearly highs actually. And we are 100% at the start of a global easing cycle. Saw that again today with the European Central Bank cutting interest rates for the second time in 3 months. Have seen some softness in the economy. ECB President Christine Lagarde saying the risks are now to the downside. They're no longer fighting inflation, now switching over to supporting growth. The market's priced in an aggressive series of rate cuts on both sides of the Atlantic, with 10 quarter-point reductions from the Fed over the next 12 months and 7 from the ECB. And this could have further knock-on effects to the yen carry trade, especially if there's a really fast loosening of rate. At the same time, Bank of Japan wants to raise rates. That could really squeeze the trade. And once again, another thing keeping downside pressure on the US dollar. If interest rates come down, at the same time, government spending stays at record high, which is already showing up as a very big problem in the amount of net interest being paid to service all that debt. Having just overtaken defense spending, and this year the US government's on track to spend $1 trillion to service their debt, up from about $350 billion 4 years ago. And so like I said, if the economy and markets do hold on, we just see a bit more softening in the jobs market. Interest rates come down, corporate profits stay up. That may just cause things to start inflating again. something no one's really expecting at all. Consensus now is inflation's been put to bed, we don't have to worry about it, which is the case right here and now, with those sharp falls in oil of late, really helped the picture out. However, we did see a bump up yesterday in core CPI month over month, coming in a little hotter than expected. Same with core PPI today, along with a bump up, and if we see commodities bounce back because demand holds up, and that narrative of a building recession and softening demand doesn't play out, along with the stock market ripping up to new highs, all that could get inflation moving up again. And I'd say that's what's not only got gold excited of late, but especially again today. We've got some little upticks in inflation with the potential for it to go back up at the same time the Fed's going to cut rates. That's super bullish for gold, and I'd say that's why we got a strong rip today. Also on the back of the ECB cutting rates, the Fed's set to cut on Wednesday, whether that's 25 or 50. That just makes gold more appealing. At the same time, the risks of inflation to come back, on top of the US dollar's value just being demolished, both internally and externally. Geopolitics, all that fun stuff happening in the background. Again, very bullish for gold. But what was interesting is with that huge rip in gold today, to brand new all-time highs, one would expect that to show up all across financial media. However, I had to go to mining.com to get you guys an article on this. And so it's interesting, all the news sites that I'm subscribed to, just looking at their home pages today, nothing said about gold, which I found really interesting. There's a speculation that the government banking cartels lost control over the price of gold. It's really not good for them, and they don't want to pile on short US dollar, long gold. And so some of the top articles are like this one here, a few other little bits and pieces. But again, just looking across the main financial media news site, we're just not really getting anything about gold, even though it just ripped up today. And again, here's a look on Market Watch, which again, we're not really getting any reports on the price of gold ripping up. Here's the Wall Street Journal, the market section. Nothing mentioned about gold here. Once again on CNBC, nowhere is gold to be found in the headline. Again, we get articles like this, but nothing about the shiny precious metal. So I just thought that was interesting. Maybe the puppet masters of mainstream media don't want them talking up gold too much, as it doesn't look good for them. They don't want a pile on the US dollar, which I think is vulnerable to further falls. Has been showing signs of trying to make a short-term bottom. However, it took a bit of a U-turn today. It looks like we could be testing this big key level of 100, which, like I said on the monthly chart here, is a big level, not only psychologically being 100, but it is a level where the market's turned a number of times, and we've actually got a huge divergence in the market for the value of the US dollar. Over the last 3.5 years has actually gone up quite a bit, even though it's pulled off from those 2022 highs. But at the same time, the US government's balance sheet has been blown out with debt. It's been high inflation, record spending, all that stuff typically long-term weakens a country's currency value. And so the US dollar could be significantly overvalued. And what's remarkable, even with that strength in the US dollar over the last couple of years, gold is still ripped in that whole time and is still well and truly leading the S&P 500. And returns this year. So as usual, don't worry if you're not getting the truth from other media outlets. Just make sure you subscribe to Click Capital and I'll keep it real for you. And just as a quick reminder, you can always find Click Capital and the daily market review over on X. Just search for Click Capital and follow me on there. And if you can't find it on there, you can always find the daily market review on my website, clickcapital.io. Just navigate to daily market review and you'll always be able to watch it on my website. And just another interesting chart I thought I'd share with you guys today, just looking at the global ETF landscape. Electronic traded funds exploded in popularity over the last 10 years, overtaking the traditional mutual fund industry. Now over 13,000 ETFs around the world, listed on multiple exchanges. Total assets under management, 14 trillion. It's gone up by almost 1 trillion just this year alone. Once again, America is the world's home of capital. 70% of the ETF market, just under 10 trillion. Canada with 3%. Coming a little bit better is Japan at 4%. And surprisingly, Europe not too bad when it comes to ETFs. 15% of the global market. Central South America, less than 1%. Africa and the Middle East, less than 1%. And surprisingly, Asia Pacific, 7%. ETFs haven't really taken off in Asia as they have in the West. Although I can tell you down under, many investors do like them, and a lot of us, myself included, have our pension funds invested in ETF. There's a look at the economic calendar today. ECB rate now at 365. There's PPI coming in a bit hotter than expected. Jobless claims coming in as expected. Looking out till tomorrow, consumer sentiment survey expected to come in at 68. And just looking at market breadth, we are seeing some signs of technical improvement today. After yesterday's big reversal, amount of stocks hitting 52-week lows fell off sharply today, both the Nasdaq and NYSE. Volatility sitting just above 17, with still a little bit of positive volatility risk premium, and just a continued bounce back in the growth versus defensive sectors. And we can see that with discretionary versus staples as well. And there's a look at the market's expectations of inflation, maybe forming a bit of a double bottom. And wouldn't this be interesting if that starts climbing back? Other than that, the real action today was in commodities. There's the commodity index as a whole, which has definitely been weak the last couple of months, helping to pull inflation down. Could be signs of a bit of a bottom here. Otherwise, as I said, you won't really see it across mainstream media, but it was gold versus the US dollar. That was the most significant move today. Brand new all-time highs. And once again, this continues to be the place to be in 2024. Thanks very much for sticking with Click Capital, and I look forward to seeing you again tomorrow night. Cheers.